It's April 7th. We've had this trade war just absolutely going crazy with these tariffs. So first thing we're gonna do is take a look at the indexes here. I've got the spot pulled off. We'll zoom out to this monthly chart so you can really get an idea of where we've been and kind of where we can go here. So looking at this monthly chart, I've got the 1 year, 2 year, 3 year, 4 year, and 5 year moving average here. If we look back at some of these past corrections or past bear markets, we came all the way through this 5 year moving average here. You can see it pretty well here looking at this GFC. Hopefully we do not get into this territory like we did in the great financial crisis back here in '08, just because that was pretty bad. And we also sliced through this. I think this is like an 11-year moving average that I have here. This is essentially a recession line. If you come down below this, you're in a serious recession. So hopefully we don't get to anything like that. But there is still room on the downside for this market to further move to the downside. And one of the reasons why I'm also showing this zoomed out monthly chart is because you can see that we're handily below this 2 year moving average right here. So we'll keep that in mind when we look at some of these other tickers. So what we're currently looking at right here is the SPY. We'll flip over to the NASDAQ QQQ. Same deal. We're set up just below this 2 year moving average right here, and moving down on time frames, we'll go over to this weekly chart. You can see that we bounced right off this November 21 peak. So this is where the market run up 2020, 2021. This is where the market, basically the buyers exhausted themselves. Sellers stepped into the market. They sold this market down, and then we rallied back up. So as you can see here, we've had some drawdowns. These are higher lows right here where we kind of approached this level, and then specifically today we opened up on this a little, basically on this level, traded underneath it, and then rallied back up for the rest of the trading session. So that's something that I'm paying close attention to. Also, if you see here, we just set just huge amounts of volume both in the QQQ on this daily chart here and also the SPY. So if we take a look at the SPY, you can also see just absolute massive amounts of volume coming in. The last 2 days, there's just been a ton of volume in this market, ton of chop. We're not really, we had a massive trading range today. Uh, let's see, I think the range was 41 points in the SPY. And our range in the QQQ, we're looking at 40 points in the QQQ. All right, so one of the things I'm looking at other than just the indexes, keeping a close eye on the dollar index, the Dixie. So anything above 100 on this index, and we're going to zoom out to a monthly chart here. Anything above 100 on this index, the dollar is strong compared to a basket of 5 currencies. And then anything below 100 and the dollar is weak. So as you can see here, we were pretty strong once the dollar index finally, came into fruition back around 2000. We had the Y2K collapse. Dollar got weak. Dollar stayed weak for what are we looking at here? 2003 all the way through 2022. So the dollar was weak for a good 2 decades here, where we had a lot of dollar weakness. And then we finally broke out. So, common misconception, everybody's saying the dollar's trash and the dollar's so weak and blah, blah, blah. No, the dollar's actually strong to relative currencies over the last 3 years. So the dollar's actually been pretty strong. This is something that I'm watching pretty closely. If the dollar were to trade under this 100 level and we get to like 98, 99, that could trigger foreign investors to pull their money out of our market. Something else I'm looking at is the 10-year treasury yield. So that will be the TNX that we look at right here. Um, and for this, I'll actually go down to the daily chart. So you can see here, we've had Fed rate cuts in the past year. They cut 50 basis points, and then yield did the opposite on the 10-year. It went up. They cut another 25 basis points and another 25 basis points here. So it's a total of 50 cuts up here between November and December right here. And as you can see, we're finally below those December and November cuts. So we're finally below that level, but we had a strong rally today in the interest rate. So that's something else that we're just that I'm personally keeping a close eye on. Trump keeps saying that he wants interest rates lower, blah blah blah. He wants a weaker dollar. So we'll see where the markets go with that. And then taking a look over here at let's look at some RSI. Or no, actually, let's go through some sectors. So we'll look at sector ETFs right now, and this is just sorted by RSI. Everything in this market is incredibly weak by sector. You can see that all the RSIs on here on this daily RSI are below 50. I mean, the market is just so weak right now. There's just a lot of damage done on these charts. So what we're looking at right here is the gold miners. The gold miners have been on a tear recently, but they've since come off. So this is a daily chart. Um, back here on the third, we were, sitting pretty, and then since then it's just sold off. So a lot of the things that had strength last week on Thursday and Friday, that strength has just gone out of the market, and they're selling what used to be strong. That's getting sold as well with the rest of the marketplace. Let's see. This is a defense infrastructure ETF right here. This was holding up pretty well, but as you can see, the last 3 days it's just been absolutely hammered. It's below its 50-day moving average. But when we compare this to the broader market, this sector ETF is holding up better than the broader market itself. I'll just pull up a quick chart of the QQQ here, so you can see just how far below the 200-day moving average that we are. This green moving average right here, we are significantly below that. So this is just going to give you some ideas on kind of where the strength is in the market, even though there's nothing really looking that great or attractive to me right now. The VanEck gold miner, junior gold miners, once again, last 3 days sold off pretty hard. Still above its 200-day moving average here. Looks like we got a bounce right here off the 100-day. XLP, this is going to be consumer staples, well below this 200-day moving average here. And this is just, like I said, we're just going through daily RSI here. The home builders, 31 RSI. I mean, we're approaching oversold territory here. So the home builders not doing too well. They peaked all the way back here in November, and it's just been a solid decline since then, below a declining 50-day moving average here. This is a renewable energy ETF. The iShares Global Clean Energy ETF, once again, not looking very good. If we zoom out here to a monthly chart, this is something that I would stay away from. It's under this recession line, not something that I'm looking to get involved in. XLU, we've got our utility select spider. So the utilities, once again, they peaked back here in November, and it's just been, kind of a steady decline. We had a lot of chop here, and then as the market broke down, utilities broke down with the market. XLY, this is the consumer discretionary. Same deal, peaked back here in December. And then since then, it's just been a solid decline. We're below a declining 50-day moving average. The 100-day moving average is starting to roll over, and we're solidly below the 200-day moving average. I'm not going to go through all of these, but I mean, all of these tickers right here, these are just, they're below these 200-day moving averages. They're literally in oversold territory on these RSI charts. And, I'll quickly tap through them. But semiconductors, a lot of damage done here on this chart. Zoom out here to the monthly real quick, so you can really see that. We're all the way touching this 3-year moving average right here on the semiconductors. So the semiconductors are leading to the downside. Another aerospace and defense ETF right there. Real estate, not looking too hot. So it's just, as we go through this sector by sector, it's not looking hot. So here you get the QQQ. So, the QQQ's been trying to hold up, but it's still below that, declining 200-day moving average. Communication services, really, this should be called like the internet ETF, but it's called communication services. But once again, just not looking too good. This is a solar ETF, a bunch of solar stocks in here, just not doing well. Financials, not doing well. Industrials, just nothing here is doing well in this market environment right now. So that's just a quick overview of the sector ETFs. Next, we'll flip over to international markets. Same deal here. Everything here on this daily section is below 50. I mean, it's just an incredibly weak market that we're looking at. First thing we have is gold. Gold market. They came for the gold market. And this is what I tell people. There's nowhere to hide. Once that bear market really hits, there's nowhere to hide in being long something. If you really are in a bear market and they're getting margin called, you got to liquidate all assets to raise capital. India, not looking so hot. Solidly below this declining 200-day moving average right here, below a declining 100-day moving average, below a 50-day declining moving average. We've got the Philippines. I mean, this is hurting everybody. It's not just the U.S. The whole world's hurting right now. It's a global margin call that we're basically is kind of what we're witnessing here. This is the Bitcoin ETF, IBIT, below its 200-day moving average here. Mexico. So Mexico had a little bit of strength 2 days ago in the marketplace, and then, as you can see, it collapsed just like everything else did. So there's just, like I said, there's just really nothing working well right here. Something that we can do though is to get a kind of a different view of this. Let's go out to this. This is the monthly RSI that I'm looking at. So we're going to actually move these charts out to this monthly chart. And here you can see we're still in overbought territory right here for gold. This is the spider for gold, GLD right here. Something else on a long-term view that's working would be the Bitcoin ETF. Spain is doing okay on this long-term monthly basis, but just looking at all this, how far we are below 2008. I mean, this is not a chart that gives me any inspiration. Germany, same thing here. Germany hasn't been able to get off this high that it made back here in 2008. The great financial crisis. It messed up a lot of countries, and the USA, we're very lucky that we're in a market that attracts all the foreign investment dollars, and our market, tends to go up over a 10-year period. A lot of these countries, you can't say the same thing for them. We're just going through here, and just a lot of these charts. I mean, back here, great financial crisis, these are where they peaked, and they've just been, kind of sideways to a little bit up, but it's like a lost decade here for a lot of these countries. So, like I said, I mean, the USA, we're pretty lucky here. Like, just look at how many of these charts are not eclipsing their 2008 highs before the great financial crisis. China's looking like crap. That does not look like a good chart to me. I mean, this chart is just so bad. You're below this recession line right here, and I mean, it's just significantly down from before 2008. So this is one of the problems that I have with Trump. Just incessantly, his whole tariff thing is like, if we have a bilateral trade deficit, then it's just, we're being taken advantage of, blah blah blah. Well, how? Prove it to me. What country is eating our lunch? What currency is just smoking us? What stock market is outperforming the U.S.? I mean, I can't see it. It doesn't show up on my charts. So it's very head scratching, kind of the policy, this disjointed policy that the whole Trump administration is taking when it comes to this. It doesn't make a lot of sense. The headlines are just all over the place. We've got countries saying that they'll drop their tariffs to zero, and the administration is saying that's not good enough. We need the non-tariff barriers to come down as well. Whatever that means, we'll find out. But my biggest thing is just really paying attention to these charts, and what is the market telling us. So that's really what I'm interested in the most here. And we'll see when this market starts to turn. It will show up in the charts. So if we look at some of these individual tickers here, I'm gonna come back here on this SPY, and we're gonna zoom in on this. And we're gonna come into this 130-minute intraday chart here on the QQQ, not the SPY, the QQQ. So looking at the Nasdaq here, as you can see, this dotted green line right here, this is the 5-day moving average. We are just solidly below this. We haven't really come above this except for once, and this is back here in the middle of March. And then we got to the 200-day moving average right here, did not get above it, completely broke down, and we start selling again once again. Got above it, back here on the 2nd of April. We're above that for just a couple hours, and then once again we opened up, significant gap down on this open, and it's just been away and away since then. So like I said, I mean, the first thing that we're going to see, if you really want to start nibbling and starting some foothold positions, I got sucked in right here, and I started, nibbling on the strong RSI plays. So that was like the exchanges like TradeWeb and CME Group and some of the insurance companies. I took a little nibble, and it didn't work. And we immediately, like I said, we got rejected at this 200-day moving average right here. The sellers stepped into the market, sold the market off. There weren't enough buyers to overcome that. And I got stopped out. So I keep stop loss orders on my positions. I got stopped out. I didn't have to think about it. The market just automatically got me out. That was that. And so since then, the market's just, like I said, we're just kind of in this extremely bearish environment right here. The RSI, if you look at this RSI level, we're oversold on this intraday chart. We are oversold on the daily chart. We are oversold on the weekly chart here. The only thing that we're not oversold on is this monthly chart. So this is like something to keep in mind here. It's just the technical setup of the marketplace right now. We still need time for this to work through, and we'll see where this goes. But as I keep saying, be patient. Just be patient and wait, and buyer opportunities will present themselves. Um, Actually, that was the 1 minute chart, huh? Weird. Um, but yeah, the only thing that we're not oversold on is this monthly chart right here. But everything else, we're oversold here, and so we're bouncing. We're trying to find support here at this November 21 peak, and hopefully we do. But like we'll take a look at the stronger stocks in the market. So this is off my watch list that I track all the earnings on. So we can go through the earnings watch list real quick. We have a grand total of um, we've got 13 stocks that are positive. Yeah, 13 stocks that are positive since they came out with their earnings. And it's not a lot of stuff out there that's working. TradeWeb is still kind of working, but once we dive into these charts, I mean, they don't look too good. And then, when we come through here and we're looking at the latest quarter that was reported, I mean, it's just all red. Like all of this column D is what I'm looking at right here. This is just all red. And there's 100 and this quarter, I've got 125 stocks on this watch list. And like I said, only 13 of these stocks are positive. So it's clearly a bearish environment that we're in. We can zoom out here to Q3. Palantir for the year is still the winner. Click over here to Q2. This goes all the way back to Q2 earnings. Palantir, once again, still the winner. Sprouts Farmers Market, Fortinet, Netflix, Catalyst Pharmaceuticals, and Celestica. Celestica has been one that I've been talking about, and they've been getting hit pretty hard, actually. And then if we look all the way back to Q1, like I said, once again, Palantir has been the best performing stock on the year. Sprouts Farmers Market, Celestica. So just keep this in mind, where we've been, where we're going. We're going into earnings season. So earnings season actually starts this Friday. We're going to start off with JP Morgan as usual and Fastenal. There's the first two on my watch list to report. That's coming in this Friday. And honestly, I'm expecting these earnings reports to be a lot of it's going to be a lot of it's going to be a lot of chaos. I'm assuming a lot of uncertainty, and I wouldn't be surprised if a lot of these companies don't issue forward guidance. To be honest with you, just because there's so many unknowns with the tariff situation. Um, so with all that said, let's take a look at what's going on in this actual watch list here. So looking at this by RSI, there's literally one stock on my entire earnings watch list that has a positive RSI on its daily chart, and that is Syncora. This is it. It's above its 20-day moving average. 20-day moving average is rising. 10-day moving average looks like it's starting to roll over. The 5-day moving average definitely is rolling over. But this is a very good looking chart here. So this is something that should be at your forefront, because when this market turns, this is what the hedge fund managers and those institutional managers and mutual fund managers, this is what they refuse to throw out. And they've thrown everything out, but they're refusing to throw this stock out right here. Next up, we've got Sprouts Farmers Market. So you can see Sprouts Farmers Market is below its 100-day moving average right here, but still handily above its 200-day. Can't say the same for the actual stock market. And then everything that we're looking at here on this daily RSI, I mean, this is all below 50. This is all just lots and lots and lots of weakness. WRB Berkeley. This is an insurance holding company. Once again, we're right here above this 50 days, so it's looking better than the better market. And this is actually holding up very, very well. This is holding up very, very well in the broader market until about 3 days ago when Trump came out with this tariff plan. That's a bunch of nonsense, and this is the sell-off that we get. We've got Booz Allen Hamilton. This is a defense company. They're kind of in the cyberspace, but they also do analytics engineering. They do a bunch of different stuff. But looking at this stock, this is solidly below this 200-day moving average. It's below its 100-day moving average. It's below declining 50-day. So, I mean, this right here, this doesn't look great to me. I'm actually going to switch this over to monthly RSI. So we're going to go for a more zoomed out view on these stocks right here. So Palantir, this is still holding up extremely, extremely well. I believe Palantir is only, I want to say it's down 8%, 7.24% since they reported earnings right here. So this is holding up pretty well. I mean, for how much the market is selling off, this is their earnings report date. We gapped up, and we're only 7% below that right now. So this stock is holding up pretty well. It's below its 100-day moving average, but we're still handily above the 200-day moving average. So this is just something to keep in mind as we wait for that follow-through day and we wait for this market to kind of pick up some steam and find some buyers here. We got Sprouts Farmers Market. This is holding up pretty well. You can see here we reported earnings, gap down on the earnings report actually, but we're not selling like crazy. So this is the thing. This stock hasn't been selling off like crazy. It's still pretty strong. It closed right here on this 100-day moving average here, and we're still handily above the 200-day in Sprouts. Another one, Spotify. Spotify's holding up pretty well, just below its 100-day moving average. We reported earnings back here on February 3rd, it looks like, gapped up. And since then, we've just been kind of trading in sync with the broader market, but still holding up better than the broader markets themselves. Cencora, we looked at that already. We've got RSG. This is a waste management group. So, well, yeah, for public services group, they do a lot of recycling, things like that. They operate landfills. Same thing with waste management. These two have been holding up pretty well, and we're sitting just on this 50-day moving average here. CME Group. So this is one of the exchanges. They Chicago Mercantile Exchange. Basically, they operate futures and options exchanges. So they're doing pretty well right now with all this volume. But like I said, when the bears come, they come for everything. So this is holding up pretty well 3 days ago. Since then, we've had some pretty solid red days here. So, this is why I tell people don't marry stocks, don't marry positions. The only thing that I'm okay with people marrying is the index. If you want to marry the QQQ and just dollar cost average that forever, that's fine. But everything else, these actual individual stocks, don't marry them. I mean, you got to be ready to get out when it's time to get out. Because if if you sit through a 50% decline of the market, you need a 100% return just to get back to even. And 100% returns don't come around very often. So, you need to be on top of your portfolio and what's going on here and have some strong sell rules. Agnico Eagle Mines, this is a gold miner right here. Gold has been on absolute fire. They were holding up very well, pushing new all-time highs while the market's below its 200-day moving average. And like I said, the bears came and they took this as well. So the bears, when they come for it, they're coming for everything. And just because your stock's holding up very well for the time being, in the future, the bears are going to come raid that as well because they need liquidity. Same thing here with Netflix, sitting just under its 100-day moving average, sitting above its 200-day moving average, holding up better than the broader market. Berkshire. Berkshire was doing extremely well in this environment. Warren Buffett, the sage of Omaha, he's sitting on $300 billion worth of cash because the market's been at high valuations the last year or so, and he didn't see any opportunities. So he's just been sitting in cash and T-bills. This is holding up very well. Last 2 days, the market has absolutely taken this to the woodshed. Took it all the way down to its 200-day moving average today. I mean, look at this. 2 days ago, we were at all-time highs. The day before, it made a new high. And then, in 2 days, we go from sitting above its 10-day moving average all the way down here to touching its 200-day. I mean, this is just absolute crazy volatility that we're seeing in the market right now. And yeah, I mean, a lot of these setups, like it's really going through here and just looking at RSI. I imagine that this stuff is going to change quite a bit once we get some follow through days here in the actual indexes themselves. But I'm not seeing anything attractive. I'm not seeing anything that really catches my eye. I mean, besides, like I said, Palantir, Sprouts Farmers Market, Spotify, Cencora, those are the kind of ones that stand out to me right now. But besides that, I mean, it's a brutal marketplace to be in. So the next thing that we're going to look at is we're going to come back over here to the index themselves. And really what we're looking for is we're going to be, when we get this follow through day, we're looking for something that's going to get us above at a minimum, an absolute minimum. We want to get above this 5-day moving average here before I would, get long anything. Before I'm starting to get long anything, I want to be above this. I want the indexes to be above that 5-day moving average. And you might have to get above this 10-day as well. But as you can see, I mean, these are just absolute steep declines that we're making here. I mean, it is just incredible volatility, incredible intensity of selling, the pace of selling. It's just we're living through these extremely fat tail risk events. Nassim Taleb, he writes a lot of books about risk, and it's honestly astonishing. I mean, we're living through these 5 sigma events that should be occurring like once every 160 years or so. And it seems like we just see them all the time now in our lifetime. We had the 2008 financial crisis. We had the dot-com the dot-com bust way back then, if you kind of remember that as a kid. We've got the COVID crash. We've got the flash crash that happened. So, like I said, I mean, these Five Sigma events, these should be generational events, but it seems like they're actually accelerating in the marketplace. Um, so yeah, taking a look at QQQ, like I said, I mean, we really want to get above this like 5-day moving average right here. And hopefully this holds as support right here, this November 21 peak. Yeah, hopefully this November 2021 peak, hopefully this holds a support for us, and we can, start to either chop sideways or, start to climb our way out of here. But there's just a lot of uncertainty in the marketplace. You can also see that November 2021 peak as well on the SPY chart. So right here, 2021, we peaked right here, and that's been acting as support so far. So hopefully this holds. If this doesn't hold, our next level of support that we're looking at could be all the way down here. And this is a significant level down. This is 358 on the SPY. We're currently sitting at 504. I don't really want to see that. So hopefully they can make some progress on these tariff negotiations, et cetera, and make some progress on this. That's really all I've got. Just be patient. We can also take a look at the VIX. So I'll pull up the VIX as well. So the VIX corresponds, it is the volatility index for the S&P 500. So we're going to look at the monthly chart of the S&P 500, and then we will pull up the VIX right here. So just to give you an idea of how much volatility is going on in this market, the only time it was more volatile was back here with the Japanese yen carry trade when this unwound. So basically, it was cheaper if you had Japanese yen. It was cheaper, or not even Japanese yen. It was just cheaper for currency traders to trade into the Japanese yen and then use that as a carry trade and invest that into U.S. assets that were returning. Treasuries were returning higher rates of return, and the yield on the yen was like dirt zero. So it didn't cost anything to have your money in yen, and then when you converted that over in dollars, you were getting the guaranteed rates of return from the U.S. Treasuries. At the time, I'm going to say it was probably like 3.8% or 3.9%, something like that. So you're getting this guaranteed return, or they were putting the money into the U.S. stock market. So it was called a carry trade. But once the Japanese yen, once interest rates from the Bank of Japan went up, and you started getting higher yield on that, it made the cost of the trade a lot more expensive, and the market unwound very, very quickly. And we got this. We went into a quick correction back here in the later half of 2024. And so that's the only time that the VIX was higher. And then before that, we have to go all the way back here to the pandemic. And this is the pandemic. When the pandemic, we're just seeing like this 12 sigma event here, where we took the VIX came from like this 12 area. This is, historically pretty low area on the VIX, and it just skyrocketed all the way up here to 80, to above 80. I mean, this is incredible. So hopefully we can get this volatility index here on the VIX to die down, and then we'll take a look at the VXN as well. So the VXN corresponds to the QQQ. Pulling our chart of the QQQ back up, and then we'll take a look at the VXN. And this is something else that I've noticed that is a little odd in this market right now. The fact that the VXN is at a lower level than the it is at a lower level than the I've got the wrong symbol pulled up here. For whatever reason, Schwab changed the symbols, but it's at a lower level than the VIX. So this is at 38.64. Usually the VXN, the volatility index of the NASDAQ 100, is higher than what we're going to see in the S&P 500. So this is something that I've been noticing the last 5 or 6 trading days. And it is a little odd. I will say it's a little odd that the VXN is lower than the VIX, but that's where we're at right now. VIX is at 46, and the VXN is at 38. So that is a little odd, but just something that I've noticed. So yeah, that's just kind of stuff going on in the marketplace right now. Hopefully seller or buyers are going to step into this marketplace at some point and start propping this market up. First buyers to come in are probably going to be the value investors. So we'll see what happens with that and where we go from there. One thing the last thing I'll take a look at is Nvidia. And so taking a look at Nvidia over here, I mean, this chart right here, it's not looking too good on this daily chart. This daily chart doesn't look very good. I mean, we basically went sideways And I'll actually start deleting. Let's delete some of these buy points off here because these are now out of date. But yeah, basically, we've went sideways. Nvidia, we chopped over. We got up to new highs here on Nvidia, and then we just started chopping sideways, and it's been brutal. It has been brutal. But this is one of the stocks that I am looking at. Once we start to rebound and recover, this could be a pretty good play. I mean, this right here, we're basically we're third off this peak right here. So it's this looks attractive. This looks attractive for once we finally rebound. We're currently 35% off that peak. So this could be a very attractive play right here. I think the price to earnings ratio and some other value metrics looking at the stock, this is the cheapest it's been in 6 years. So this could be a really good opportunity, and there will be a good opportunity once this bear market shifts over to bull. It's just patience. I keep saying it. I keep saying it. Just be patient. Be patient. Have cash on hand, ready to deploy. Once we get that follow through day, start nibbling with some high quality stocks, um, and just be ready. That's all I can really say. Is just kind of be ready for when this market's going to turn because it will turn eventually. That's all I got.